It's a pleasure to have with us John Quigley, who is Managing Partner and Co-Chief Investment Officer at Advanced Investment Partners. He joined the firm in 2000 and has over 17 years of investment experience. John, it's a pleasure to have you.
Thanks for having me, John.
Well, why don't we perhaps just start with your background and the focus of your firm, and then we'll delve more into your quantitative approach to investing.
Sure. My background is, I guess, kind of starting back when I was a kid. When I first became interested in investing, I grew up as a big baseball fan, and looking at the huge spread of statistics every Sunday in the paper. Kind of combing through those, what looked most similar in the newspaper on a day-to-day basis were the quotes pages, of course, from the stock exchange. So that's really kind of what first drew my interest and attention. I guess combining that with the fact that I always enjoyed mathematics, and then kind of the more that I got to learn about investing, the deeper my passion grew for investing. So I really enjoyed not only the quantitative style that we employ, but I also enjoy reading about what a lot of other great investors do. I went to Wake Forest University in North Carolina. Have a degree in economics. Was really influenced by studying under Professor John Wood, who's definitely a genius, enough of a genius that it was sometimes hard to relate to what he was explaining. But he was also an advocate of the efficient market hypothesis, which kind of didn't agree with my personal feelings about how the market worked. From Wake Forest, I joined a company called LBS Capital Management here in Florida. LBS at the time managed about $750 million. They were a pioneer in the use of artificial intelligence. So they were using expert systems, neural networks, genetic algorithms to evaluate the risk in the overall market, as well as beginning to profile individual stocks. So, kind of way back in the mid to early 90s, LBS Capital Management was featured in Barron's for their use of artificial intelligence. We were even on ABC's Nightline one time for our use of artificial intelligence. Um, I, from there, while I was at LBS, I took on a role as an analyst, so building some of these models myself. Grew into a portfolio management role where I was building sector rotation strategies and global tactical asset allocation strategies. Began working on quantitative stock selection models. And in the meantime, as I was doing this type of work, Advanced Investment Partners, my current firm, actually spun out of LBS Capital Management. So that's why I've been with the firm since 2000, even though I've worked with Doug Case, my co-CIO, since 1995. So as I mentioned, I really admire the style and the thought process behind people like Sam Zell, Steve Romick, Bob Rodriguez, Seth Klarman, Kyle Bass, the Tisches, their ability to view situations from different perspectives. Combine that with maybe Henry Singleton and his emphasis on remaining flexible in the investment environment. Charlie Munger for stressing multidisciplinary thinking. Michael Mauboussin acknowledging the importance of recognizing behavioral shifts across the market. And then I think outside the investing world, if you look to John Wooden, who's really kind of the famous basketball coach from UCLA, who's really famous for preferring a simpler approach wherever possible and kind of showing up every day and putting in the effort, and that you see a cumulative benefit of that type of approach through time.
Great. Well, your firm has several strategies, but perhaps we could abstract it one level, and maybe you could just tell us generally what the quantitative philosophy is based on, and what are some of the guiding principles of that?
Sure. Certainly the efficient market hypothesis is the most well publicized, I guess, academic view of the market. There is a competing theory of market behavior called rational beliefs, rather than the rational expectations espoused by the efficient market hypothesis. The rational beliefs states that rather than investors having an absolute knowledge of the true underlying market structure and dynamics, market dynamics actually evolve in unpredictable ways, and that forces investors to evolve their behavior as they search for what the new underlying market structure is. So that type of belief runs through our philosophy, as well as some of the the traits that I mentioned earlier among some more famous investors. So, first and foremost, we believe that active management can work, but it's important that one understands that no single approach is going to work equally well across all market segments, and no single approach is going to work consistently through time. And therefore, we believe that it's very important to employ a wide array of characteristics when we're evaluating companies. So we're going to take really the disciplined approach used by the best value investors, investors that really monitor quality, growth investors, and so other investors really follow sentiment more closely, and then still others are more short-term traders that are evaluating trading patterns around stocks. So we kind of take what we think is the best of breed approach from each of those classes of investors. We customize our evaluation approach for different market segments. So, for example, when we're looking at a smaller cap stock, we're not only going to evaluate that company relative to the small cap opportunity set, but we're also going to look at that company relative to its economic sector peers, and we're going to look at that company relative to its market cap and style group peers. And then finally, from an evaluation perspective, we believe that, again, markets are very dynamic in nature, and therefore the modeling approach itself also has to be dynamic in nature. So once we've determined which characteristics have the most explanatory power within each of these segments of the market, we're going to allow our models to adapt to the changing influence of each of those characteristics. So it's going to be more of a dynamic, evolving weight that's given to each of the most important characteristics.
And what are some of the ways that these dynamic weights change over time, or are there some stock selection criteria that are sort of the bread and butter of the model that you could talk about?
Yeah, I guess in terms of examples of how the models evolve through time, I think a good example that's fairly straightforward would be the rewards to price momentum. So looking at the returns of a stock or all stocks from 13 months prior to 1 month prior to today, so that 12-month period. But typically, the investors have found that stocks with strong price momentum will tend to continue outperforming the market. So that's a generalization. And what we found is that the direction that you'd want to tilt on something like price momentum is not consistent through time. So in other words, that may generally be the case that companies that have outperformed over the previous year will continue to outperform. But in fact, if you look at the payoff to price momentum on a time series basis, you'll see points in time where, yes, you have been rewarded for owning stocks that have strong price momentum, but there are other points in time where you would have been better off favoring stocks that had underperformed over the past year. So a tangible example of when that would be true is if you think about market behavior and what was being rewarded throughout late 2007, 2008, and on into the first quarter of 2009, companies, the market was very defensive in nature over that time. Investors had a very strong risk aversion. and it was a very consistent, strong risk aversion. So the leadership was very consistent as the market on the whole was falling apart over that time period. So that would have been a period in time where, even though the market was sliding, you would have been best off remaining in the market leaders during that time. So price momentum worked actually very well during that year and a half period of time. As the market bottomed in early March of 2009, the leadership in the market changed on really completely on its head. So from March 9th forward, certainly through the balance of 2009 into early 2010, it would have been preferable to own companies which had outperformed for the year leading up to March 9th. So that would have been a period of time from March 9th through 2009 through early part of 2010 where you would have effectively either wanted to have been short price momentum, or at least you would have wanted to have an inverse tilt on price momentum. You would have wanted to own the laggards in terms of price momentum from March 9th forward. So this is an example of where you see two unique windows of time where in the first half of the window from late 07 through early 09, you would have preferred to be long or tilt towards companies with strong price momentum. From March 9th over the following year, you would have wanted to take the opposite position.
And are there any pointers or factors that would kind of tilt the model in the right direction? I mean, how do you decide whether to, assume that price momentum will continue or that it will reverse?
Right. So this is an entirely quantitative-driven process, and what we're doing in practice is, once we've determined the characteristics that have the most explanatory power, we're using those inside a regression-based framework. So it's a rolling regression where we're assessing the importance of these characteristics as they relate to the forward returns of stocks over the past 3-year period, and also over a shorter window, about the most recent 4-month time period. So we're kind of looking at things from both a shorter-term perspective and a longer-term perspective. We're using these regression-based models to measure the importance of those characteristics inside the current environment, believing that the current environment is certainly it's not going to completely match with the past environment, but it's going to rhyme with the environment. And by stepping the regression window forward 1 week at a time, as we move through time, the importance of the characteristics, the weights and the directions of these characteristics are going to automatically adapt as part of that rolling regression-based process. So we're not doing anything from a predictive top-down type of a modeling approach. Instead, it is monitoring the importance of these characteristics in their recent time frames.
I'd like to talk a little bit about the value factors in your model. Which have you found to be particularly important and useful to you?
Yeah, we're really using a pretty wide array of valuation characteristics, and as I mentioned, it's not only going to be valuation characteristics, but also what many would consider to be quality type characteristics. So let me give you an example of some of the characteristics that we've found are more interesting in terms of, at least in terms of having very good explanatory power. We're really not looking for I guess characteristics that are way outside of the box, because the exercise here for us is not necessarily to look at stocks in a way that's completely different than other investors are looking at stocks. Rather, the exercise is to look at stocks in a way that where we can monitor and evaluate how the majority of investors what they're basing their decisions on. So it's again more the the explanatory power of the characteristics, if you will, more so than using the characteristics to lead us to undiscovered ideas, if that makes sense. In terms of characteristics that we look to, we're looking at again, fairly basic things. We're looking at operating earnings to enterprise value. We're looking at cash flow to enterprise value. We're looking at enterprise value to sales. We're looking at the various free cash flow measures related to price. We're looking at forward earnings yield. We're looking at sales to price. We're looking at yield, and we're also looking at not only dividend yield but also share buyback activity. Those are basic valuation characteristics that we're looking at. We're also from more of a quality type standpoint. We're looking at return on capital measures. We're looking at earnings quality, so looking at the pattern in accrual-based earnings. We're looking at the leverage that companies are employing, so their equity to debt. We're looking at the trends in the profit margin. We're looking at the free cash flows in terms of the volatility of those free cash flows and the growth associated with those cash flows. So those are the type of indicators that we would look at in terms of getting a view of what type of valuation approach is currently in favor across the market.
There have been some pretty prominent books published on, quantitative approaches to investing, including O'Shaughnessy's What Works on Wall Street and Joel Greenblatt's The Magic Formula book.
Mm-hmm.
Have you looked at things like the Magic Formula? Greenblatt has said that even the two-factor model does pretty well. How do you evaluate something like that, and how have you guys improved upon it?
Yeah, the big difference I think between the approaches and the books that you mentioned and our approach is I guess there are a couple of different aspects. One is that those two books in particular apply. They really rely more upon a more traditional method of characteristic or factor evaluation, in that they assume that a characteristic is only going to pay off in a certain direction. And by that I mean that, again, I gave the example of price momentum, but another example might be something like price to book or price to earnings, where one assumes that you always want to favor companies that have low price to earnings ratio or low price to book ratios, and that what's important in those approaches, the books that you mentioned, is the average payoff to those factors through time. Now, if you look at the time series of payoffs, so the real life experience of investors that are using those approaches, the payoff or the volatility of that payoff through time is going to be, it can be substantial. There are going to be extended periods where selecting stocks according to those methods is going to underperform by a large margin. And I think that Joel Greenblatt acknowledges that there are extended periods where if he weren't careful, there would be periods where effectively he could lose all of his invested capital. Our philosophy is that markets are going to evolve through time, and that it doesn't make sense to take a single, to assume that a characteristic is only going to pay off in a single direction. In other words, if you think about owning low price to earnings stocks, what that assumes is that investors are always very concerned and highly concerned on average with valuation. If you think back to the late 1990s as an example, at that point in time, investors did not care about valuation whatsoever. What they cared about was earnings growth. The ability to grow earnings was much more important than what you had to pay for those earnings. So in fact, if you measured the payoff to price to earnings during that window of time, you would have been punished severely if that was your stock selection criteria. And this is true in episodes through time, that you'll have significant drawdowns in terms of the reward to using those type of static stock selection factors. So we believe that having a dynamic, adaptive approach to using those type of characteristics is far superior in terms of the consistency of rewards to be earned by our investors.
How do you then appraise the market today, if you will, in terms of what investors are really looking for? Obviously, indices are doing pretty well. So what does your firm think about what factors are most relevant today?
In terms of the overall market, looking at things from a characteristics perspective, so, which characteristics are in favor throughout our models, this would be a point in time where we are finding, particularly among smaller caps, that price momentum, so gains in stock price over the past year, is very indicative of future expected gains in stocks. So price momentum is something that you want to favor in portfolios. Right now, you also want to favor companies that have a higher than average dividend yield, that have a lower than average or a higher than average earnings yield, which means a lower than average price to earnings ratio. Companies that have very strong return on capital are very much in favor, be that earnings-based or cash-based return on capital. We also are favoring companies that have a high degree of operating leverage, and we're favoring companies that one of the things we like to measure is, and it's a good gauge for risk appetite across the market, is are investors preferring companies where Wall Street analysts have a high amount of disagreement among future earnings expectations, or are Wall Street analysts tightly grouped in terms of their earnings estimates around a certain company? Right now, at this point in time, we're finding that investors are preferring companies where analyst estimates are tightly grouped, and that type of behavior is indicative of a market that is rather risk-averse in nature. So this is not to say that the market itself won't continue to appreciate, but within the market, investors seem to be preferring slightly less risky stocks by that measure.
There's that saying, sell in May and go away. I'm sure you're familiar with it and probably have looked at whether it actually has worked as a strategy in the past. So you just mentioned that investors are perhaps a little more conservative. Would that mean that perhaps such a strategy would pay off?
Yeah, I think that's a little bit different in terms of what we're looking at, because that implies more of a top-down type of risk aversion, where investors might not want to be long equities from May through the end of the year. We don't really focus on making those type of decisions. For our investors, our job is to remain invested in the market and to really rotate into the portion of the market that we expect to outperform the broader market. And so what we're seeing is that, I think that there's still room for the market to appreciate in terms of the market's overall valuation. It seems to be right in line with historic norms. It's no longer cheap as it has been for an extended period of time. I think with the most recent bout of appreciation across the market has brought us to valuation levels that are right at historic norms. But I think also if you look at valuation as it's related in the past to the level of economic growth that we have right now, which is very modest, the level of broad price appreciation, the inflation in the environment is very modest. That would tell you, those two indicators, looking at those two indicators would tell you that valuation's got room to appreciate fairly significantly. That's typically almost the Goldilocks scenario. Now, as you know, and as people that read your publication know, there are a lot of other factors that make the market a little bit riskier than you would typically see in that low growth, low inflation environment. But those type of risks are being counteracted in a very big way by central bank intervention. The amount of monetary stimulus that we have across the economy, not only our economy but across the globe, is enormously supportive of equity prices. So I think that the market sell in May and go away. We don't make those top-down calls explicitly, but in looking at a wide array of information, I would say that I don't know that that's going to be the best alternative for investors this year, number one. Number two, as you stay invested in the market, we do believe that you're better off owning securities or companies that are less risky on margin, on average.
And you mentioned that certain factors can kind of cut both ways or go in both directions. Do you at all employ short selling strategies then that use those factors as well?
We've run long-short strategies in the past, along with portable alpha strategies. So we would be equitizing market exposure and pairing that with a long-short portfolio, where we would be balanced on a dollar basis between long and short. So yes, we do have information flowing through the system that would show both where we'd want to be long the market and where we would want to be short the market. But most of what I've been discussing today is related to long-only investments.
And perhaps as we finish up, what are some good resources that investors could go to learn more about the type of investing that you do, quantitative style of investing? Is there more on your website, or are there any books you could recommend?
Sure. There are a number of white papers that really describe our process in pretty good detail in different aspects of our process. So our website is aipllc.com. And there's a section on there with both our newsletters and our white papers. And we try to be very transparent in what we're doing rather than a typical black box approach that's employed by a lot of quantitative investors. In terms of the history of a quantitative approach, which I think is a good place to start, certainly I would recommend Capital Ideas by Bernstein. There's Capital Ideas 1 and Capital Ideas Evolving. Capital Ideas really gives you a great history about quantitative investing, where it came from, and Capital Ideas Evolving really talks about where quantitative investing is going.
Well, on that note, John, I want to thank you very much for your time and your insights.
Thank you, John.